We're at a very interesting spot of the market at the moment in the real estate. The date of this recording, December the 3rd, 2022. Like I saw, we're all just trying to work out which way the market's going and how bad it's going to be, or whether it's just going to be a flat line until the economy picks up again. I'm not an economist. I'm a realtor who is trying to sort of do my own research and hopefully pass this on to other folks who have the same interest in trying to time the market as to when to buy, when to sell, both for your residential property or for investment property. So without further ado, let's just hop into it and see if we can sort of shed some light on this. My name is Fraser Bolwell, and I'm with Homesanytime at I&I Realty. As a quick disclaimer, anything that I share with you today, please check with your professional real estate agent before implementing any of these strategies. Watch this video to the end, as I'll be providing a bunch of links on how to buy smartly, how to invest and build wealth in your home, as well as to invest with investor-grade tools. The real estate market does work a lot slower than stock market or gold. You have plenty of time with the indicators I'm going to share with you. You have plenty of time to make up your decisions, get your house on the market or prepare to buy, whatever the indications are. But it is a little bit dry, so stick with me. There's a lot of valuable information here. And at the end, I'll be able to provide you with some valuable tools that I hope you can use in a lifetime. Some of the leading indicators that we use move quicker and slower than others, but looking at them overall, just briefly outlining what they all are. Obviously, the interest rates is a common factor for a bust or a boom. Housing inventory, supply and demand, and the US unemployment rates, obviously it's all balanced on the economy of the country, and the consumer price index. Obviously, you know, with inflation, we're seeing things going up, so we've got indicators to help us see whether it's turning, and of course consumer confidence. Everyone's overall feeling for the country. Are they out spending, buying cars, buying houses? And of course, the 10-year yield and the 2-year yield curve is one of the leading indicators that we use to foresee possible recessions coming up. And in fact, this one has predicted every recession since 1955. And it's so advanced that it's going to predict 6 to 24 months in advance. So as I mentioned earlier on, stock market, gold, they move a lot quicker. 6 to 24 months, you have plenty of time to make a decision, get your house on the market, or prepare to start getting ready to buy. And of course, the gross domestic product, export, import, how healthy is the manufacturing industry. Frank Martell, CEO of CoreLogic, states that home prices are going to continue to appreciate, basically because the millennials are entering the market in their prime years, and of course renters are trying to escape the high rent costs, and investors with deep pockets are still trying to push the demand. Of course, there's a chronic underbuild, so there's nearly 3 million homes shortage in the US. So there's still a great demand for property that's not going to be resolved, certainly within the next 5 to 10 years. So on this side of things, there is the demand. So let's just look on the other side of things to see how the economy is going to either squash it or move forward. The 10-year Treasury bond is a major indicator giving us plenty of warning of what may be happening in the future. Just to basically just give you a brief idea what the Treasury bond is, it's where the government is raising funds to go ahead and try and cover the government expenses and pay national bills. Also, they can be sold in either 1 year, 1 to 10 year, or 10 plus years. Obviously, the longer the money is left in, the higher the yield. And of course, the volatility is going to sort of, if you're invested in, say, gold, for example, and the economy is looking a little shaky, then people move their money over into Treasury bonds, where you're going to have a higher return rate until the market settles down. Obviously, a higher yield is going to be giving us higher mortgage rates and slower spending. The falling of the yield increases the house buying and there's more finance available. So this is an inverted curve showing the 10-year Treasury bond minus the 2-year Treasury bond as a yield. So typically the 10-year should be yielding a higher return or yield, and the 2-year should be beneath it. But in this particular case, you can see where the 10-year is earning higher than the 2, and then now right here you can see where the 2-year is earning more than the 10. So back in 2007, as an early prediction, this is where it's happening again, and it started happening here as well. So it's an early warning signal that there is some weakness in the market coming. This one here is a 10-year minus a 2. So beneath the line is where the inverted curve is happening. And the blue line is housing pricing. So in 2006, this is where the market was weak again. And of course, house pricing is still peaking, again giving early warning. And as I'd mentioned earlier on, it does take 6 to 24 months for the actual recession to fully take effect. So that is your early warning signal. And then, of course, right here, we've got prices peaking, and of course, our 2-year is beneath. If you ever want to know where the mortgage rates are going to be going, just look at the 10-year Treasury bond. You can see from this graph here, the blue line is the 30-year fixed mortgage rate, and the red is the 10-year Treasury bond. So they follow their patterns very closely, correlating it pretty closely, sometimes giving you a bit of an edge as to knowing which way they're going to go. So why do the mortgage rates follow the 10-year Treasury bond so closely? Well, the 10-year Treasury bond is the benchmark. And of course, for the mortgage to be competitive, the mortgage-backed securities are in direct competition with the Treasury bonds. So to be competitive in the eyes of the investor, the rates in the mortgage inherently follows the change in the Treasury bond yields. Here we have the inflation. We all know that we are experiencing a lot of inflation. The built-in inflation occurs when workers are demanding higher wages, and in turn the businesses are requiring to push up their prices to cover the cost of the wages. Currently, we're experiencing a combination of cost pull and demand pull inflation, which hasn't been seen since 1970. The differences is in a demand pull inflation is where there's not enough services. This could be from COVID to keep up with demand, and cost pull inflation, on the other hand, is occurring when the businesses don't have the materials and therefore are charging higher costs. So this is a graph about the inventory that we have. You can see during 2021 how it was dropping off quite dramatically, and now 22, 23, with inflation, the demand is lacking due to higher mortgage rates, higher rents, the slowing down of the economy. Nevertheless, we have still got a problem of having insufficient property to supply. A recession doesn't mean it's falling prices. It just means that there's been a deacceleration. As you can see in this graph, the last 6 recessions, only on 2 occasions has the market gone into a negative. So we really are anticipating either to be just above or possibly flatlining before we start seeing an increase. Once the inflation is controlled, you're going to start seeing the interest rates start dropping, as we're already seeing now. As you can see in the past 6 recessions, how the interest rates have dropped in order to get the consumer confidence to come back and start looking to start buying and selling your boats, your houses, your cars. As this chart is showing the 30-year and 15-year, you can see that our interest rates are peaking. With it being December the 3rd, the anticipated interest rates are possibly going to be dropping on December the 14th, in which case, confidence is building for the new year. This is where people are anticipating the interest rates to go in the last quarter, where we are now, and into the new year. As we know, we've had a lot of construction going on with condos and houses, trying to meet the demand. But as you can see over here, the lumber prices have dropped off tremendously, which means house starts have stopped as well. You've got the red line is the house pricing and lumber. So no, this is another indication showing you, obviously for a selling side, where to time the market in order to sell at the highest point. So as soon as lumber starts coming down and housing start coming down, that's when you need to looking at selling to maximize your selling profit on the property. It's all well and good to make these anticipations of what the interest rates are going to do with the market, but of course, the balancing act is what is going to happen to unemployment. If the inflation isn't controlled to the extent that they hope it will be, then of course unemployment is going to start going up, and that's going to sort of prolong all the interest rates coming down to where people were hoping it to be. So as this chart is showing here, you can see where the high unemployment was. It's back under control now. So if that starts coming up again, then that may prolong the recovery. Once big money sees that the market is balancing out and it's time to start construction again, you'll see all the housing starts start going up. So this chart here is showing you, this purple line is the amount of building starts, permitting, and then the red line is housing pricing. So interesting story. I wish I'd known about this a long time ago. I got into a pre-construction purchase in 2006. So housing starts and everything started coming down, and housing pricing was going up. So had I seen this chart in 2006, I most certainly wouldn't have purchased, because by the time I went to purchase a property with a pre-construction 2-year development, the prices had already collapsed. And here's a good indication over 2 years that while they were building that property, I wasn't appreciating, I was depreciating. So again, you can see what's happening here now. Housing pricing going up, building permits have just dropped. So again, if you've just purchased a house, things are kind of flatlining, not getting quite the right time that you had anticipated. So as a general review, just going over all the different indicators, we see that home equity in our properties is really good. We've got a very low delinquency rate. We have a 2-year and a 10-year yield inverted, which is not good. That's showing obviously that a weak economy. Housing pricing is deaccelerating. As I've shown you, I think it's going to be sort of, I don't believe we're going to go negative, but it's just deaccelerating. It's not dropping, getting the rates that we were used to. 30-year mortgage looks like it's beginning to drop a bit. The inflation is dropping. House inventory is a demand, so that's good. So when the market starts picking up again, the demand is there, and of course, pricing is going to come back. There is a housing shortage, which is again for the demand. Lumber prices are down, so we've got to watch to see when that starts coming back. Building permits also are down, so once those two start showing an increase, we may be back on the road to recovery. And of course, the unemployment, if that it's good at the moment, but if that starts coming back up again, it will kind of delay things. So as we know, the housing market does go in cycles, and it's especially this last series, we've had a real good run. Where we are at the moment, Jacksonville is in the slowing, and then we've got to go through falling, bottom, and then recovery. Different cities around the nation have different positions, as you can see here. But Jacksonville, we're in the slowing, and again, hopefully we'll see better pricing and things balancing out in February or the first quarter of next year. Florida last year certainly enjoyed a good appreciation, as you can see here. We're 29.77. We were the largest increase in the nation. With Jacksonville, we had a 29.0% increase appreciation with our property. So I think we've all had a good run. Having a little pullback, a slowdown, is to be expected, and prepare for better times. Here's an interesting piece from Mark Fleming, the first American chief economist. As homeowners gain equity in their homes, they are more likely to consider using that equity to purchase a larger or more attractive home. The wealth effect of rising equity. In today's housing market, fast rising demand against limited supply of homes for sale has resulted in continued house price appreciation. Here's a piece from Dave Ramsey. Right now is the best time to buy a house in the next 5 years, and here's why. Prices are not going to go down. They're going to go up slowly, but they're not going to go down. And so 5 years from today, houses are going to be more expensive. So this is the best price right now if you're going to buy a house. Dave Ramsey. Americans' top 4 choices for the best long-term investment. As you can see, real estate is 35%, stocks, savings. The stocks, you can still go down in pricing. You never know what's going to happen on the other side of the world, but real estate is always going to appreciate, and in my mind, that's a good place to put your money. For folks that are renting versus buying, here's an example of, renting is all well and good, and you may have good reasoning to do that, but at the end of the day, all you're doing is paying off someone else's mortgage. So, for example, here you have a rental payment, your insurance, here your costs if you're going to be purchasing a property. You got $1,500, about the same, but here's a graph showing you what your cost would be over 30 years as a homeowner. It's going to be a flat line, same cost, whereas your rent increasing is going to continue to go up. So, if you're a first-time buyer, I would certainly consider looking into it, unless, of course, you've got good reason to want to rent. If it's a credit issue, there's definitely things that you can do to work around that to get you into a home. Home ownership is not only the best investment that you can make, but it also gives you so much more satisfaction too, of security. Here's something that says, one of the surveys, non-financial benefits of home ownership. 93% of people say it's made them happier. 88% of people say it's the best choice they've ever made, and 79% of people have said owning a home has changed their life for the better. I represent Homesanytime.com at INI Realty Inc. And as a program that we offer Jacksonville residents only, is a program that empowers people to try and understand the equity in their property. It's a wonderful software. Once you sign up, you receive a financial digest every month on your property, its value, where you are with your equity. It shows you where you are in the real estate cycle. It suggests times when you should refinance and what program you should take. All the financial information provided is updated every week with interest rates and things like that. Taking cash out if you've got equity in your property, and what you can afford to buy as a second home, an investment property, or even just if you want to expand improvements in your own home. This is something that you'll get every month, and it's something that you can use for life. And it's definitely a way as a homeowner to know the maximum way of benefiting your equity in your property. It's something that you just need to sign up with us, and there are going to be links below as to where you can go to do this. Just try it out. You'll see the value in it, and I'm sure you'll appreciate it. If you're on the buying side, there's also a digest or an option to sign up for, where it's going to help you buy smarter using investor grade tools. Understanding the right properties to buy. It's going to show you the square footage in different parts of Jacksonville, where the value of property is better in one area than another, where the hot areas are, what's selling quicker, are there pockets of opportunity somewhere. All of these things are provided in that monthly digest, or if you just go into want to search for a property of your desire. So as I say, take advantage of this. It is a complimentary service that we provide, and your property will be valued to what it is at that time. In other words, these electronic appraisals that are done can get you within a ballpark. It does fine-tune the property, so if you've got updates or you could put in a new pool since it was purchased, you're going to be massaging that number to where it is, and then as appreciation happens, it's adjusting for that, and then of course as interest rates change, it's showing you where the cycle of that property is. So this is where it is. We did feature this on CNBC, ABC, and Fox. Let me just quickly show you. So you'd simply come to our website. It's homesanytime.com, and then you would just, if you're a homeowner, you would go to Build Wealth with your home, and you would just register there. Or if you were buying a property, buy smarter and build wealth faster. So you just put in the criteria where you want to go. Once we've done the onboarding with you, you would receive an email in your email box once a month, and it would come in as your reporter's update to your property address, and it would be coming from Amanda Bolwell at homesanytime.com. And this is what it would look like. It would come in like this. You would see your value. This would be the platform. So you can see how this one's appreciated, how much net worth we got in it. There's various emails of Amanda telling you different opportunities that you have with the property, what you've paid down, what you owe. This is refinancing. how many years you intend to be in the property. If it's in red, that means it's not suggested at this time. If you pay more money into it, how much it's going to reduce your how much quicker you're going to be able to pay down that property. Different ideas of what you could purchase, and this goes, you click on these things, it takes you deeper into it as to how much you can afford for a second home, a holiday home. Like I mentioned, if it's green, it's suggested. If it's red, it's probably not a good idea. So it's very easy information and very intuitive. If you're unsure as to what your equity is in the property, we have pulled from public record what you owe, what rates you're doing, and how much equity that you have in the property. Just in closing, thank you so much for spending a few minutes with me as we share this with you. So please certainly go ahead and make some comments, ask your questions in the box below. Of course, the links to the various to subscribe to the wealth building, both either buying or selling, are going to be listed below, or just go to the website homesanytime.com. You'll find videos, other educational videos, as well as the blogs. So again, thank you so very much, and good luck with everything.